So here we are at the 12th day of Christmas, and this is going to be our last video in this series. If you've enjoyed these videos, then after this one please do visit WeMakeMints.com. On our eDVD on trading discipline you will have tips just like these, and remember we done that DVD before this, so the main tips that we wanted to give you guys is on that DVD, not these video series. However, I'm sure you'll agree that these have been very useful for your trading. Let's go in and delve into our last tip for Christmas. Okay, so here it is. What have we got? Okay, so tip number one, stop losses with high prices. What we want to talk about on this one is there's been a lot of interest on trading gold, and gold at the time of this video is around $1,300 per ounce. We're a believer that gold is going to go lower, so we've been selling rallies, and so has a lot of people that have been following We Make Mints. We've had a few messages on Facebook, people saying, look, we want to sell gold at this level, this is where we want to put our stop loss for tomorrow. What do you say about that? And they're only risking about 5 points, and we're saying to them, you have to expect more swings on gold. We actually done a video on our eDVD on stop losses on gold. Because people were asking so many questions about it. But what we want to say is, a lot of people don't realise this. The higher price an asset, a share, gold or whatever, the more volatile the swings are. Now, you might understand it if we put it this way. If you buy a share that's 10 pence a share, you buy it at 10 pence and you put your stop loss at 9p a share, that doesn't seem excessive, but you are risking 10%, okay? A lot of traders are happy with that. If they was then to buy a share that is £10 a share and they put their stop loss at £9, they're risking the same amount, that's 10%. Yet a lot of traders won't do that because they think, no, that's too much, putting your stop loss at £9, that's way too much of a gap. But you've got to remember, the higher price something is, and there's lots of shares out there that are £10 a share, the higher the price of the shares, the more volatile the swings are going to be. It's going to go down 10 pence just as it loses or depreciates by 1%. So you've got to counter that into your analysis and your trading plan. If you're trading the FTSE and the FTSE's at 6,500, the swing, 1% swing, is going to be a lot more points than if the FTSE was at 500. So bear that in mind. If you are trading something that is £5, £6, £7 a share, and there's lots of shares like that, then do counter that in. The higher the price, the more volatile the swings are going to be, the wider your stop losses need to be. If you are having putting a tight stop loss on a share that's £10, £9, £8, then you might be on the right side of the market. You might think the share's going to go up, so you buy the shares, but if your stop loss is too tight, chances are one of them swings is going to take your stop loss out and then it's going to go higher, and you're going to kick yourself because you're going to think, I lost money and I could have made money because your stop was too tight. So do bear that in mind. The higher the price, the more volatile the swings are going to be, the wider your stop loss is needed to be. Okay, so that does conclude our 12 tips of Christmas. We do hope that you've enjoyed this mini series. Do go on to WeMakeMints.com. There is many more videos like this on our eDVD section, and we do hope you had a beautiful, lovely Christmas, and thank you. We do appreciate your time and following our videos.